This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking, the podcast with Melissa Griffiths
and me, Steve Dobson.
This is the podcast that takes a deeper dive into the alternative marketplace and explores topical issues. We're delighted today to be joined by Jeffrey Faustin, Managing Partner and CIO of Jenson Funding Partners, and also Kealan Doyle, CEO and Co-Founder of Symvan Capital. We're going to look into EIS and SEIS in particular, and lovely to see you.
Great to see you.
And
thank you for having me on.
Yeah, no, we're delighted. Now, we normally like to kick off with a bit of a sort of background on yourself and also Symvan Capital. Could you give us a quick?
Sure. I mean, Symvan has been going since 2014. We always run an evergreen EIS and SEIS funds. We've been, I guess there's about 10 of us now. We're I think if I was going to describe us and how to differentiate is we're very performance-led rather than marketing-led.
Okay.
In a nutshell. So we don't have the largest AUM, well, although we have a decent amount now, but we're amongst the top performers, I think.
And you're particularly in technology, is that right?
Yeah,
in terms of sector?
B2B SaaS is kind of our sweet spot.
Right.
So we're not into life sciences or university spin-outs, although we have one or two of those, but we're not consumer-based.
No.
We're more business-to-business, improving productivity, that kind of thing.
Which is interesting because you've been doing this for how long now at Symvan, in terms of...
Well, at Symvan since 2014.
Okay.
But my co-founder Nick and I have been working together since 2005. In fact, in this very...
This very building, yes.
I hear
yes.
we're in the CEO's office at the moment.
Yes, we're in the old CEO's office. So I'm now the CEO, and I am now in this office.
Yes.
But it's a very different office than it was back then.
You didn't have this beautiful sofa.
No, we didn't have
the
the great sofa, no.
Kealan, thanks for your intro. And to you, Jeffrey, as well, welcome to the podcast. Could you do the same? Give us a brief history of yourself and of Jenson Funding Partners too, please.
No problem at all. Thanks for having us here. Jenson Funding Partners has been an early stage SES fund manager for the last 12 years since the scheme started.
Yep.
We focus on SES and also ES investments, and we've been doing that since 2012. I joined Jenson back in 2012/13 as an intern, and kind of I've been doing everything under the sun since then. I'm now kind of co-managing partner of Jenson along with one of the co-founders, Sarah Barber.
Fantastic. Cool. And you say you've got both SEIS and EIS. Originally, I believe you started with an SEIS fund, correct?
Yes, that's correct. We started when the scheme started back in 2012 with an SES fund.
Yep.
I think one of the first to put a fund wrapper around the scheme.
Mm-hmm.
And we've been going ever since. We've done kind of 150 odd investments ever since then, with a focus on just kind of tech and tech digital businesses in generally.
Cool. And then, Kealan, you mentioned as well about you've obviously got the SEIS and EIS. And one of the things you mentioned was the flow of investment from SEIS into the EIS fund. Is that the norm? Do most companies that arrive in your EIS funds have original funding through SEIS, or is it a different selection process? How do how does that normally flow?
Yeah, a lot of our companies in our EIS portfolio started at SEIS, but by no means because you're in an SEIS do you graduate to EIS.
Right.
And I think the reason we got interested in such early stage was Nick and myself, our background was doing stuff like IPOs for tech companies, that kind of thing. And you'd often get tech companies that kind of like teenagers, their head is bigger than their feet or vice versa. And which, unlike traditional businesses, so we kind of got interested in let's look at this as an incubator because the tax breaks are so. As a matter of fact, when we first got involved, it was slightly later than Jenson. But there was a period where if your entire portfolio went bust, you actually got 0.5% back.
100.5.
Now, it didn't last long if you had a capital gain.
Yeah.
Oh, right.
That didn't last long. The treasury, and that's, I think, why we have 50% tax relief on capital gains now. So it was sort of like, this is interesting. I mean, you only really have to have in a SEIS fund 1 or 2 winners to make it all worthwhile, and we have quite a few, and I think Jenson as well have quite a few more than that.
Yeah.
So it's a pretty interesting investment class. One of my bugbears is the FCA saying, take 2 minutes to read this, you can lose all your money. No, you can't, unless us as fund managers do it wrongly.
Yes.
Because you get tax relief, you get loss relief.
Because am I right in saying that for a higher rate taxpayer in SEIS, is it 38.5% versus 27.5% basically is your maximum loss as a higher rate taxpayer in each of the schemes?
Well, it used to be. Jeffrey, you might be more up on this because tax changed recently, but it used to be 13.5p if you had a capital gain.
Yeah, correct.
Oh, with the capital gain.
13.5p capital at risk.
Yeah.
And unlimited upside.
Yeah.
So yeah, it's pretty attractive. I remember one of our companies was Google and GSV in the Valley in California had an incubator. GSV is like a Series B sort of investor, and I remember meeting a lot of early stage VCs in the Valley and angels and whatever, and they just couldn't believe EIS.
Yeah.
Well, it's a very unique scheme, isn't it, to the UK? And the other thing as well, I think that people forget with EIS and SEIS is you've also got the inheritance tax, advantages as well. So,
That's a good point.
It's a great combination,
Yeah.
particularly with new legislation that's come in from the UK government. Yes, I think... Do you agree, Steve?
No, I agree. But Jeffrey, is it similar for Jenson in terms of there's a progression from the SEIS fund into the EIS?
Yes, it is. We set up our first EIS fund a couple of years after we started, particularly because we saw the need for that equity gap between SES and the later stage EIS companies that are around. So we set up a fund specifically for early stage EIS. But yes, our strategy is actually specifically to have only our SES portfolio companies graduate
to the exclusively graduated.
Exclusively, and we've set a target of having only the top 25% of our portfolio come through. So we kind of really have a conviction approach. We want to see founders executing as we expect, but we also want to see market fit. We want to see that graduation to the ES levels. Yeah.
And then for both of you, I guess, selecting SEIS companies, investee companies, because these are very early stage. It's got to be within the first 3 years of their trading life. It's very conceptual, I guess, for a lot of these as well. So how do you go about, selecting the companies? And I guess secondly, for an investor coming into the fund, that risk mitigation, obviously it's going into numerous companies, but they are risky by nature of the stage these companies are at. How do you go about that process?
Well, there's a series of ways that we do it. I'm sure Kealan is very similar. If we look at the different risk factors that you have to look at. So obviously there's individual company risks, so we do a portfolio. So we do a minimum of 8, probably 10 to 15 is what we try to aim for in terms of diversification. So you have that kind of mitigation. We've got cash flow risk as well. Most companies fail because they run out of cash. So we have a really strong financial cash flow process that we put all companies through. So every single company that we invest in, we do our own financial model for them. We do a deep dive into that and make sure that, we can see evidence of either a milestone that can credibly raise another round of funding, but preferably profitability. Yeah. So we prefer what we call low revenue profitability as opposed to kind of high revenue, non-profitable scale, just growing fast without profitability. So that's key for us as well. So those are the two things. And then the third thing that we look at is the founder risk, which is obviously, as Kealan was talking about, the, feet not on the ground. Yeah. We have a minimum of 2 founders that we look at, but key thing for us is diversification of thought as opposed to diversification of any other type, because you can have 3 founders looking very different but thinking the same way. Yeah. And we want to have that balanced team, that diversification of thought, and at least minimum 2 people is kind of how we manage that. So those are the 3 kind of main risks.
Okay, interesting. And Kealan?
We're slightly different. We just flip a coin. No, seriously. We have our philosophy is sort of choose a few SEIS companies a year, 5, 6, 7. There's some, and I think it's very intertwined with our philosophy, which is we think the old Silicon Valley spray and play model is not fit for purpose. Not just because times have changed, but also because I think Europe is a bit different from America. Yeah. I don't think Uber would have happened in England, right? That wouldn't have happened. We used to have a presentation where we showed some of the seed investors, because they IPO'd more or less about 10 years after they started. And, you know, if you had 25 grand invested, as some of the angels did, you know, that turned into like 100 million. I forget the figures exactly, but it was an extraordinary return. I think we're more interested in working with companies. We don't just sort of splash the cash and hope for the best. And that starts with SEIS. So we spend it on, we probably lose money on SEIS. I mean, it was, thank God, it increased to 250 grand from 150, because we were definitely losing money at 150. But long term, you know, it's like, well, you're ex-Goldman Sachs. Long-term greed, I think, is their
That's one of
motto,
the
right? And that was kind of our philosophy when we started and looking at SES, and it's more or less worked out.
Yeah.
That's what I'm interested in. What do you see across SEIS and EIS as sort of the time scale? And, you know, how do you see it going for an investor? Because one thing we've seen recently is a lot of investors who have gone into both SEIS and EIS getting frustrated. They thought it was sort of a 7-year kind of potential exit or, you know, holding. I mean, obviously we all talk about it being patient capital, but people are now looking more like 10, 12 years. Well, we know we've had COVID and a lot of economical difficulties and political that have not helped. But what do you see now? I mean, we've had new legislation as well, haven't we? We've moved. What's the new law we've now got with SEIS? Has that made a significant difference as well? The amount's gone up to 200,000, hasn't it?
The amount has certainly changed. But if you think of private equity and venture capital funds, they tend to be 10-year funds with an extension to 12 potentially, right? So this whole thing about, I want to exit in 4 or 5 years, particularly for SEIS, it's not very realistic.
No.
But if you look at it, like what I always say to people is, don't look at this as a liquid asset, because it's not.
No.
It should be your best, to wealth managers, it should be the best performing part, but you've got to be patient, and it could be 7, it could be 8, it could be 9 years. We had an exit last year from an SEIS company that's all the capital they needed. They didn't need any EIS, but it was about 8.5 years. We've had others that are less than the 3-year times, where, you know, when you have to disregard the tax and just look at
you don't get them.
And I think that 3-year, and I've been in the Treasury and I've talked to them about this. That was relevant when we had an asset-backed market, which used to be.
That's what I always think, that you, particularly for you guys, when you're in tech, that growth could happen a lot quicker than that.
Exactly.
And therefore you're sort of in that, what's wagging the tail of the dog, isn't it? Is it the tax benefit, or you want the growth? And, you know, I guess there's a balance for the investor and for you about what that's actually driving it.
Yeah, I think it's about managing expectations stuff with the investors. And I think at the beginning, when the scheme started, it could have been that investors were kind of led to believe that it was a shorter time frame, but in reality, it is longer. It takes longer.
Yes.
To exit, particularly if you want a good exit. You have to decide whether you come out at a B or you stay in sometimes. But we are seeing our exits taking significantly longer. COVID hasn't helped.
No.
But I think even if you disregard COVID, you will still be looking at kind of 7-year plus range, I think, realistically.
Yeah, COVID, for us anyway, COVID stopped any M&A activity. It just died. I'm sure there's some people it didn't, but for us it did. And then when it started coming back, because obviously tech has been in a bear market for a while. I think it's on the way up, but it hasn't had a good few years after having a crazy few years. We were walking away at SEIS level, actually. We were walking away from so many deals because the valuations they were just crazy. Yeah. And, because I'm not 25 years old anymore, I've seen this a few times, and I know what happens, and it always is the same. And, you get convertibles, and valuations collapse, and companies collapse.
Yeah.
And there's been a lot of companies that have collapsed.
Yeah.
And, when down rounds happen, they're not 5% or 10%. They're significantly more than that. And we've seen that.
Yes.
So...
how do you think you get the balance right for you as managers for those companies? Because you want to do the best you can for those companies to help them grow, to get to, ideally in a unicorn stage. It's not going to happen for all companies, but you want to grow them to that stage, versus the wants and needs of investors that are potentially looking for earlier exits to regenerate some cash, and maybe similar to what they can do with a VCT, where they can reinvest after 5 years and get the tax relief again. how do you balance that between the optimum or effectively getting that optimum exit?
I guess like most questions, it depends, right?
Yeah.
But for us, anyway, we look at the time that opportunity arises to see how long we've been in, and then when is the next realistic time frame, and we have to take a view on that, really. Anything over 10 years we think is a bit difficult to wait on, and then of course a bid in hand.
Yeah.
So you have to look at it from that perspective. Most of the times we'll come out at that opportunity. We've had a few occasions similar to Kealan where we've come out before the 3 years because the opportunity made sense. It was, it got the investors' returns, even if you consider, repaying the tax and paying CGT on top of that. But generally, you look at, you have to look at that time frame to see what makes sense. Considering if you think 7 years is the median, you want to be as close to that as possible, I think.
So that's a target, ideally, if you can optimize there.
Yeah.
Similar.
We have a case right now where we're selling a company that's actually a majority SEIS and a little bit of EIS. And the SEIS, we're waiting for March 31st because then 3 years will pass. And the EIS, we're gonna lose, but it's a fairly small position, but there's going to be a situation where there's going to be, people are selling before 3 years. So it's not perfect, but on the other hand, you can't allow the tax to drive it, to change the investment, because you really don't know when you can sell these companies.
No.
Like, this is really in a sweet spot for someone, and so it's working. But if you just think about the tax, hence why I'm so, on my high horse about the 3-year rule. I just think it's totally outdated. I think Treasury needs to look at this again.
Which is, there's a lot that they are starting to look at. And one thing I'm always quite fascinated on the capital market side and the lack of IPOs. And we all know that there's a lack of, IPOs in particularly AIM. We've had a lot of changes in the sort of small mid-cap marketplace, and it's very under pressure with a huge amount of outflows. What are your thoughts in terms of, I think we had Sam Smith on last week, who was very vocal about how, we are getting to a crucial point in the UK and we need a catalyst to almost change this. What's your sort of thoughts on this?
I wish the IPO market would come back.
Yeah.
I think it's a real tragedy that we're being left behind. Almost none of our companies think of IPOs, whereas that's very different from, I was around the internet boom of the 1990s,
like the
right?
TMT.
And everyone thought about that.
Yeah. I had you'll like this. Well, you might not like it. I had so I worked through the TMT rally and then the crash. But my new thing was ABC, which was AI, blockchain, and cannabis. What I thought were going to be the new growth sectors. So you guys could be a bit in that.
Well, I was fortunate enough to be in Stockholm for the award of the Nobel Prize for Physics for Jeffrey Hinton, the godfather of AI. And we've established a relationship with one of my old universities, University of Toronto, where he famously sold his company in 2023. He developed AI for Google, basically.
Right.
And then has come out and is very critical of Google. Well, basically, you remember they used to talk about don't be evil? Well, they dropped that a long time ago. and particularly with respect to AI. But he's founded something called the Center for Ethical AI at the University of Toronto, and we're trying to integrate some of our companies in that as there's a lot of interesting stuff happening there. But Toronto is also a leader in cannabis, as it happens.
Exactly, yes. Yes.
Those days have passed me by.
No comment.
I don't know how we've gone to this angle.
Slightly gone off piece here. Back to the IPO market then. So you do feel then that it would be crucial for you, particularly with your investee companies, to be able to find a way. Is that sort of naturally where you can see more of your investee companies looking as exits?
For me, indirectly, not directly. I think the time frame to IPO is still way longer than we would want for our investments. But definitely, having that clear path to IPO, having later stage companies be able to IPO gives us an acquisition opportunity for our companies, and I see that more as a realistic approach for our fund specifically. But yes, absolutely. We want to see way more IPOs. I have a dangerous amount of knowledge of this, so I might be very wrong in what I'm saying. But for us, my understanding is that it's the Series B market where we're lacking the funds to help kind of push those companies through, and that's probably where we need to have the focus. There's a lot of government initiatives about getting companies to some sort of exchange. I would want to see that.
Sorry.
Go ahead.
You remember these days when there was an active AIM IPO market.
Yes.
And the
Which was
whole
very
infrastructure
buoyant.
has disappeared. There's no research anymore done
No.
on these stocks, right? There's no market. There used to be 40 market makers or something. Now there's maybe 2 or 3. Once you take away that infrastructure, it's very difficult to build that back up again.
Yes.
And, part of that was to do with MiFID. Ironically, it just became uneconomical for people to do mid-market IPOs. And I remember one of the companies that we had, one of the ones that went bust, I should add. I always like to talk about failures, because if you don't talk about failures, you're not in venture
It's part of the
capital.
business, isn't it?
It is.
Yeah.
Yes.
And this company was one of the investors. We did, I think it proves our life cycle approach. We SEIS'd it, which at that time the maximum was 150 grand. And then they kept on saying, do you want to put more money in the EIS? And no, we don't hit you're not hitting the metrics. And anyway, there was a company that were an AIM-listed company that shall remain nameless, posing as an alternative debt provider. And actually, they were putting debt in, but it was more like equity. And then in the end, it ended up that we got 1p back on the pound or whatever. Because they converted, and the company went nowhere. But I was thinking to myself, if you had an analyst covering you, you wouldn't be getting away with this,
Right.
Yeah,
right? An analyst who was looking at it would be saying, "Hold on a sec, you're not sticking true to what you're advertising to
So you're
investors."
doing, yeah.
And that's a real crucial element to why the AIM market is no longer vibrant. Because at one point, 20 years ago, it was very vibrant.
Yes, well, there were a lot more stockbrokers around
Yeah.
and playing in the space, weren't there, I think?
And now I think it's distorted by the whole BR market,
Yeah.
Yes,
right? And
which is a new. But we also do have the LSE are bringing out Pisces, aren't they? Which is I think there's more detail to come on that. But that is, again, I guess, for you guys, going to be interesting as
yes.
some sort of way of...
Well, I was just going to talk about that because, IPO, the whole reason for the IPO is the fact that you want more liquidity, right? You want to find out routes out. And, finding some sort of secondary market is probably another way to look at it. We've seen lots try and fail, but we'll be interested to see what happens.
Yes, to see how that creates, a different way.
And I guess based on what you both said there, then, in terms of the exits you're seeing currently over the last, 4 or 5 years, is it mainly coming from M&A then, even though M&A activity has been super low, but is it more private equity coming in and buying up these companies or bigger companies buying them versus the IPOs that we used to see?
For us specifically, we are seeing a decent balance between private equity and just acquisitions from actually fairly young companies raising funds and then doing a kind of an acquisition strategy of their own. So we've seen a lot of that. We're hoping to see one of our first Series B kind of clearing out the cap tables coming up soon this year. And then we've had a couple MBOs as well.
Cool. And yourself?
For us, it's very much trade, more than private equity.
Yeah.
Bit of private equity, but more trade.
More trade purchases, yeah. Interesting. And then I guess the other thing I picked up that you mentioned earlier about for advisors when they're talking about advising to their clients and, the EIS, SEIS are the areas where they could look for bigger returns. It's still staggering, and I know these are risky investments, but it's still staggering the low numbers of people investing in these. Looking on the HMRC stats, around about 40,000 investors claiming tax relief on EIS, 9,000, 8,000, 9,000 on SEIS, and then we talked on the VCT one recently, it was around about 26,000. These are really small numbers if you think about the population of the UK and the investable, people that theoretically could invest. Why do you think it is as it is? Take away the kind of risk aspect, but what is it? Advisors not talking about it to their clients? Is it
I think
lack
there's
of
a big
knowledge?
element. I think there's a big element to that.
Yeah.
Because I remember doing Intelligent Partnership. I don't know if you know those guys, and going around Leeds and Bristol or whatever, and I'd see people, you'd go with a bunch of other fund managers and present, and they'd come up and I'd say to them, "You don't really like EIS, do you?" They go, "No, we don't like it at all.
Right.
It's a small part of our, but your best clients all want to do EIS."
Yeah.
And I think a lot of advisors are afraid of it.
Yeah.
And it's a lot of work for not a lot of money.
Yeah.
Because really what you want is you want to do due diligence on the funds.
Yes.
If you're going the fund route, some a lot of EIS people just are angel investors and whatever, and they do diligence on the companies. But if you're going the fund route, that's what you should spend most of your time doing. And if you get the right investment firm, it'll be the best part of your portfolio, or it should be.
Yeah.
It shouldn't be a lot of your portfolio. It shouldn't be 80%, but it should be the 10% or whatever that really makes the difference. So if you look at a DFM product for a wealth manager, that should return like 6.5%, maybe 7% over 20, 30 years. And I think that's the way people have to think about it. No one thinks about pensions in terms of, I need liquidity tomorrow. They shouldn't think of EIS or VCT for that matter.
Yeah.
In that, it's patient capital.
Exactly. Yeah.
If you want impatient capital, be in a money market fund.
Exactly.
Yes.
Yeah.
Well, and I think that I personally feel there is an awful lot of requirements for education, isn't it? And I do think people are nervous to dip their toes in. We've seen often VCTs tend to be a little bit more popular initially because I think they're listed, and it is just that view that you do have a possible exit. But at the end of the day, we're seeing more and more movement towards semi-liquids. And people are beginning to understand that liquidity can be a longer term way to make investments, and great for your portfolio to get great performance results.
But if you think about it, I mean, I don't know how. I got lucky because and bought a house in the mid-90s in central London. I say lucky because I didn't think I was going to be staying there, but I then kind of figured out I was, and I bought a house. And that's probably one of the best investments I've ever made.
Yes.
It's not a liquid investment.
No, it's patient capital again, isn't it? Really? Yeah.
It's not a money market fund.
No.
And there's a wealth manager from Goldman Sachs who I know who says to me one of his big challenges is convincing his clients they don't need as much liquidity as they have.
Yes.
Go for less liquidity, and so in this case he was talking about private equity funds.
But this is also where I refocus again on the inheritance tax side, because I do think people underestimate the benefit therefore. It's patient capital, but also it does, no one quite knows what's around the corner, and you do have the benefit after 2 years.
Yes.
It is out of your estate,
Yes.
So, and if you're investing in which a lot of the beneficiaries would be interested in potentially tech, or there's sustainability options, or now there's a lot of areas where you can invest for your the next generation to be able to go into areas that they love as part of their inheritance tax portfolio.
Yeah, absolutely.
Well, there's a big play in the wealth from what I've seen, and Jeffrey, you may have seen similar or different. A lot of people basically have been betrayed by this government. If you're someone who's saved hard, right? So if you have pensions, for instance, you've been told for many, many years to save for pensions and it'll all pay off, but that's not true anymore. Now that is in your estate.
Yeah.
Yes.
And it wasn't. And there's one of the bigger wealth manager groups that we do business with told me there's a huge move from people who moving their pensions into EIS and SEIS.
Yes.
Yes, makes sense. Yeah.
Yes.
And
And
I think
that's-
that's going to be. We're waiting, aren't we, for the actual detail in the
Yes.
pensions, and I
Yeah.
think that's next 27, isn't it? I think, but and that will give us. But so I guess from your point of view, are you beginning to see more interest coming into the SEIS and EIS market with a lot of the new legislation that the Labour government's brought?
We still think is a lot of education that has to go on before we see that. Particularly with the IFAs, I still think it's a long wait for us to see that come through. It hasn't trickled through for us. I don't know about you, Kealan.
It's a much better if you have someone who's got selling a business or something like that, sort of complicated tax situation.
Yes.
They tend to use EIS.
But alongside with a tax advisor who's actually specialising in
with
it.
a chartered financial planner.
Suggesting
Yeah.
it.
Much more so, whereas I think VCT is more of a retail product.
Yes.
Yeah.
Yeah.
If you have
people are saying
10
it-
grand,
Yeah,
it's so much easier for an advisor, right? If you give me 10 grand for our EIS fund, you get 10 certificates.
Yeah.
Now we make that easy for them administratively, but it's easy just to say, here's a VCT, boom, done.
Products, yeah.
But if you've sold a business or something, you have capital gains to consider, IHT, etc. Then you start finding, and so I think you get bigger tickets in EIS than you,
Yes.
than you would with
Yeah.
VCT.
And it's detailed tax planning, isn't it? Where really
Yeah.
I think it sort of runs alongside with tax advisors and the tax planning side to be able to really specialise in what's required. So as always, I like a few statistics, and I find it interesting looking back at EIS in particular. And since its inception in 1994, EIS has supported the development of high-growth businesses across the UK. To date, EIS and its sister scheme SEIS have collectively driven 32 billion of investment into over 56,000 companies, according to the recent Bohurst report. One thing that I think we'd like to focus on is what you see, Kealan, as the key differences between SEIS and EIS and the benefits for Symvan of running two different funds in those.
So we look at SEIS as our incubator for our EIS and for our EIS funds, and we roughly have a split of 90% AUM in EIS and 10% in SEIS, and not all of them make it.
Yeah.
But I suppose one of the reasons we got interested in SEIS is we saw a gap in the market. There used to be well, first of all, when I first came to this country, because I grew up in Canada, and I worked at what was then called UBS Phillips and Drew, and there was no venture capital industry in this country. Venture was something that they did in California, maybe a little bit Israel. And it's changed completely. And I think EIS, which was founded under John Major and the then Chancellor Kenneth Clark, really was there to stop the sort of brain drain. That there's a whole generation of English, mostly men at that time, who would be engineers from Cambridge or whatever, and they went off to Portland or Seattle or wherever. And so I think it's been a resounding success. But EIS and SEIS are basically the same thing. Obviously SEIS is more generous and they're younger companies, but they lead into one another.
I'm just conscious of time now because I think we could talk for a long time, but I think we're running out of time. So I think we'll natural close there. Thank you both for joining us. Some really good information you provided, and we'd love to have you both back on again at some point. I think there's lots more we can talk about here.
Yes, particularly the new markets. I think let's see what happens.
Let's see what happens with Pisces as well.
Yes, Pisces.
Yes, definitely Pisces.
Yeah, I think it's a good one. Thank you, guys.
Thank you.
Thank you. Please like and subscribe to Alternative Thinking from Growth Invest on YouTube, Spotify, and wherever you get your podcasts.